So markets don't move randomly, they react to events, be it data, global decisions, or policies. So as we enter into 2026, there are going to be few events which are worth watching. So instead of predicting what is going to happen in the market, let's try to understand what all events or which key events in the first 3 months of 2026 are worth watching and why they matter for economies and financial markets. Hello guys, my name is Himang and welcome to Basics with Himang. So in today's video, goal will remain simple, better understanding and calmer decisions. Let's begin. So on 27th and 28th of January, US Federal Reserve is going to hold its policy meeting. So in this meeting, US Federal Reserve decides on US interest rate and provides guidance on inflation and growth outlook. So why this policy meeting matters a lot? Because US Fed Reserve influences global liquidity, currency movements and investors' risk appetite, not just in the US but worldwide. So if we need to look at the impact that it is going to have, well, in simple words, it is going to impact the stock market, bond yields, currencies, and capital flows into emerging markets like India. So, key learning from this event is that global markets often react to expectation, not just decisions. So, that is precisely why central bank communications matters as much as actions. So India's union budget is expected around 1st February 2026. So budget usually outlines government spending and taxation, borrowing and growth priorities for the year. So why it matters? It matters because it affects business sentiments, consumption and long-term growth direction and fiscal discipline. So investors usually look out for three things. First is tax changes, second is government spending and capital expenditure, and third is fiscal deficit targets. So if we have to look at the key learning from this event, well, key learning is that budget influences sentiments first, then fundamentals later. What it means? It means that short-term market reactions do not always reflect long-term impact. So RBI Monetary Committee Policy MPC is going to meet between 4 to 6 February 2026. So in this meeting, RBI decides on India's key interest rates and liquidity stance. Why this event matters a lot? Because interest rates impact loans, savings, investments, and overall economic activity. So this event will have an immediate impact on the bonds market. However, equity markets are going to respond based on future growth and borrowing conditions. So key learning from this event is that interest rates affect all asset classes, not just loans. Indian government is releasing new and updated base year series from 2026 onwards. For instance, new retail inflation data with 2024 as base year will be released around 12th February, and new GDP data with the 2022 and 23 as base year will be released around 27th of February. So why this event would matter a lot? Because inflation data would influence RBI decision policy, and GDP data would help us understand economic momentum. So any unexpected inflation or growth number can trigger a short-term volatility in stock market. So if we have to look at the key learning, well, key learning is that economic data guides policy and policy in turn guides markets. So in February 2026, general elections are scheduled in Bangladesh and global political developments continue elsewhere. So why this event would matter a lot? Because political stability affects trade and regional confidence and capital flows. And this would have an impact on stock market, as stock markets don't like uncertainty, as the political events tend to increase short-term volatility. So key learning from this event is that markets often react to uncertainty more than outcomes. So in March 2026, global institutions like IMF and World Bank and global research firms, they are going to provide an update on growth and risk outlooks, and this will influence long-term investors' positioning and asset allocation. Well, these events will not have an immediate impact in short term on stock market. However, a long-term expectations would be set. So key learning from this event is that long-term expectation is guided by trends, not by headlines. So if we look at the first 3 months of 2026, then there are few core themes that we should be monitoring. For instance, interest rates direction, government spending priorities, inflation trends, global growth signals, and political uncertainty. So, if we monitor all these events, then we would understand how markets are reacting to all these events, and then we can take decisions accordingly. I hope you liked today's video. Thank you for watching, and I'll see you soon.